Broadcast is now starting. All attendees are in listen-only mode.
Good evening. Welcome to Virtual Investment Club of Sacramento. My name's Jay Eagleson. I'm president of this club. As a matter of fact, today is my last meeting as a president of the club. We will have a new president and new executive team starting next month. It was my privilege and honor to be a part of the team which set up the club and lead it for 2 years. This is a great online club, and I hope that you enjoy our meeting, and I liked our club's diversification, dedication, experience that each of a club member contributes. I look forward so many more successful years to educate and building ourselves as a lifelong successful investors. So the stocks that we are going to present tonight, they are not a recommendation to buy or sell. We ask you to do your own research, and it is totally an educational purposes for us. Any of the stocks that we discussed tonight is for educational purposes. So I went through a disclaimer. Next, that we will go over to Treasurer's report. Roy is our treasurer, but he's not here tonight, and so Henny is going to be backup. And Henny, can you show us how do we do as our club
Sure.
portfolio?
Could I
I
get
will make-
control? Yep.
Yes, I will give to you right now.
Okay, can you see my screen?
Yes.
Okay, so first of all, you'll notice this is a summary of our club holdings. This is live, so I'm going to play around with it a little bit, so just to make it easier to see. So the first thing, I'll sort by purchase, and you'll see that last meeting rather, we made 4 purchases: Facebook, FleetCor Technologies, Middleby, and another Facebook, and Skyworks. So the shares held are over here, and essentially we put in $1,000 for each of those purchases. Now, if we look at our unrealized gain loss, I'll sort by highest to lowest. Our best performer is IPGP Photonics, and that's sitting at over 171%, followed by Hyco and Five Below, FleetCor, High Crush Partners, and Skyworks. The rest are struggling, but overall, the portfolio is still doing well. So if I'm going to switch over to performance, and now this is the dark green line that you see here is our portfolio, and this is the Morningstar U.S. Market Index, Total Market Index. We have a lot of mid-size companies, so if we want, we can Morningstar Mid Cap. We could compare to that, and that's actually we've done even better than the Mid Cap. You can see here since purchase, since we first started, we're sitting at 25% return, and 1 year is 23%. Year to date, we're down 0.12%. So overall, I think we're doing fairly well. I'll just very quickly, I want to make a couple of points about how. So this is a diversification report from iClub Central, and I highlighted 4 companies that are that make up a significant portion of the portfolio. Ideally, we shouldn't have more than 5%, but we've got Facebook at 14, and Skyworks at 8, IPGP at 9 or 10 almost, and FleetCor at 9. Now, both FleetCor and IPG, I think, we're got to that level because of the returns rather than purchases. In the case of Facebook, we bought it 3 or 4 times, which I think goes against sort of the a rule of thumb, which is not having a position that's more than roughly 5%. So going forward, we may want to do some rebalancing at some point. So I'll let you think about that.
I have not, sorry, Henny, I have not heard about this 5%. I thought 5% is because this whole everything is 100% divided by, you know, when we invested the $1,000 to give us 5%, right? And about 5% for each company. That's the base. Then obviously some companies will do well, like IPGP. I think it's still okay. What I understood is portfolio management is, you know, when you triple or much more, then you have to think about sell some portion of it, or some of a much lower percentage. You may think about whether to get rid of it or you buy more. So I did not know about this 5% actually. Is that the better investing guideline?
For me, I don't agree with 5%. I think that's too low.
I did not know about this 5%. I thought 5% for us is just because we invest $1,000, that is a 5%, and then from that 5%, we see how we do.
I've heard that. Other people think that it's not necessarily a golden rule, but when I had a Fidelity advisor for a while, they use that 5% too, so you wouldn't lose so much. But it's just a loose rule. I think you can use or not use.
Okay, so I think in the future, if we for our next education topic, we should definitely talk about portfolio management. How do we train our portfolio, rebalancing, like Henny you mentioned? Sorry, I can carry on. Yeah.
Can I be heard?
Yeah, Tom.
Oh, just thank you. I didn't know if you could hear me.
Can you hear louder? Can you talk louder, Tom?
Oh, okay. If we have 5%, then that means we need 20 stocks. That's a lot of stocks involved.
Oh yeah, that's right. Yeah.
That's too many stocks.
Yeah, no, not 20. So how do we look at Biogen? I'm just looking overall. I have to do the math. So we have 13 stocks, right? So 100% divided by 13, about 6-7%. So, right?
Yes.
Yes,
Yeah.
but we also have cash. So at some point,
right.
I'm assuming that.
So for us, we have 13 stocks is about 7%. Now we need to mute the mic, making background noise. Thank you. So yeah, we should have about 6-7% actually for us. Yeah, for our portfolio.
People also recommend you have between 8 and 20 stocks too, so that's probably where it comes from.
Yeah,
It's
probably. Yeah.
It's a matter of kind of personal opinion too. Some people feel more comfortable one way or the other with more stocks or less stocks. I don't think it's an iron rule. And anyhow, for us, I think 5% is too small a percentage. That's mine. Yeah.
I think we just did a math.
So if I can just interrupt, so we can. I just brought it up. You can think about it. I think for the sake of just keeping on schedule, certainly let's maybe think about that, research it, and then we can maybe discuss it next week.
Yeah. Or
next
during the education topic, we
Sure.
do some research and present. But definitely, medium-sized company is the meat of the portfolio, which we have.
Yes.
Better investing recommendations of 50%, 50. Yeah. Okay. Sorry, you can carry on now.
Okay. So the next, my mouse is not working. Oops, here we go. Okay. So Morningstar divides stocks into 3 super sectors, they call them: cyclical, defensive, and sensitive. And I didn't know what sensitive meant, so I looked it up, and it's basically something that falls in between defensive and cyclical. These are companies that are not going to be impacted too heavily by a poor economy. They'll be impacted to some extent, and the stocks typically in those kinds of industries have a beta that's close to 1, and a beta is market volatility. If you have a stock with a beta that's greater than 1, then it's it's more volatile than the average within the market, and if you have a beta less than 1, it's less volatile than the average stocks in the market as a whole. So beta of 1 is average volatility in the relatively speaking. Now, if you look at the sectors that are not represented, those are the ones I've highlighted here: communications and energy. So you have, and I put some of these definitions just so that people get a sense of what kind of industries will fall into a defensive super sector, sensitive and cyclical. So the ones that we don't have are communications and energy, but we have quite about 56% that's sensitive. So we probably want to increase our exposure to defensive and consumer defensive stocks going forward, just to get a balance. Any questions on that, or?
No, that's excellent.
Okay.
After you finish, can you leave this slide, which that slide leads me to talk about why we picked the industry for tonight's stock studies, and
Sure.
we definitely looked at that. Okay, you can carry on, finish. Yeah.
Okay. So these are just, again, further. So these are the super sectors, and then these are the sectors within those super sectors. So and this is again how our portfolio is split up. So we have a lot in technology, about 32%, and then industrials at 24 roughly. And then after that, it's consumer, cyclical, and cash. So I would say cash is pretty defensive at the moment, and but we might again want to think about that balance. So two things: do we have exposure to a few companies? So Facebook comes to mind. 14% is quite high, and we don't have a whole lot of exposure to defensive sectors. So going forward, these are things that we might want to consider. And that's my report.
Great.
Thank you. If we go to defensive, that sectors don't perform as well. I don't know. So you might be more secure, but you might have lower performance. I'm not sure. Yes.
It depends on where we are in the economic cycle. So if we're going into a bear market, then you want to be certainly more heavily weighted in defensive stocks, because they'll weather the storm.
Can I ask a question about that, weathering the storm? If we're not going to use your money today, why do you need to weather a storm if, when the storm is over 10 years later, that you're behind? That's kind of the same. I've always wondered why to use defensive things if you lose half your money, but you know it's going to come back eventually, because it does every 20 years. Why do people use defensive things? I mean, is it just to make you feel better that you haven't lost all your money? I mean, the point that they don't grow as much, I think, is more important than that. But that's why I'm asking the question. What other reason?
I think it's a personal preference, but
yes,
you want to have a balanced portfolio. So if you have exposure to, say, cyclical stocks, and those are not doing well, then the portfolio is going to be impacted significantly, and you'll have to wait longer to recover. And
right.
So if you have a balanced portfolio, then
but if your time horizon is long, then recovery would be greater when the recovery occurs if you don't have defensive sector. Do you think that's true or not?
Yeah, that's true for sure.
Okay.
So it's a personal thing depending on your age and your time horizon. Yes, that's right.
Okay, right. Thanks.
And I think better investing has traditionally looked for fast-growing companies, and in this consumer defensive, these companies are growing like maybe 5%, and it's hard to make those pencil out as a good investment for the stock selection guide unless they're growing at a faster rate.
Right.
Yeah.
Well, one thing that better investing doesn't pay a lot of attention to is dividends. And so you could have some, you know, utility, for example, that's got a long-term contract for power generation, and they're humming along at 5%, but they're also paying a hefty dividend. And so, you know, you might get 7, 8, 9%, depending on how big the dividend is. So that kind of balances out the fact that they're not.
That's actually a good point, because Morningstar has two portfolios. One of them was the more defensive. It was the dividend sector, where you got 6 or 7% dividend and 3% growth, and the other one was 7% growth and 3% dividend. So that makes sense, yeah.
Mm.
But over time, the growth, if you have a stock with a 6% dividend and 3% growth, and another stock with the opposite, over time, the growth stock will significantly outperform the dividend stock.
Yeah,
that's true, Bernard.
I've
But
lost half my money twice, though. And I think on an emotional level, I mean, on paper, let's put it that way. On an emotional level, I think that's the advantage of having defensive things. You just don't feel so devastated, but I don't know for sure.
Right. So okay, Henny, you finished your report?
yes.
Okay. So I want to,
Thank
next
you.
on the meeting, thank you, Henny. Yeah, this is great. Henny is running for our treasurer for the next year, and now you can think about it, whether, you know, I think he will be a great treasurer for us for the next new year. So have this slide. So next thing on the meeting agenda is a stock study, and I want to talk about, we have a leasing and what was it? Leasing services, air and leasing. So we just start, when we are looking for the new stocks to study, we just look for the sectors that we don't have. So we briefly looked at the industry. We're using BetterInvesting, the screening tool. We looked at industry, we looked at energies, and I think we looked at communications. It did not just look good for us. And for the consumer defensive, I have to admit, we really did not dive into, but we tried to get ideas, get started. So we looked at heat map, try to see, you know, what looks kind of based on the BetterInvesting members, Sacramento, what are the companies look better, and it did not have anything kind of catch our attention. So we did not really spend a lot of time looking into consumer defensive. However, I do agree with what you all said, that we should think about balance our portfolio and diversify our portfolio. I will encourage the future next month stock study committees to look into a consumer defense, like a food beverage, to see if a Starbucks is good to buy, or education training, or that in that area. Oh, we also looked at utilities as well, and we just thought that we did not dive into detail, but we looked at a couple companies, just did not come anything strong. So that was why, and we decided to, then we looked at company, the small, medium, large. We want to find the small size companies, and we kind of towards that area. End up, for some reason, Air Lease actually just barely passed. It's a small size, it's a medium-sized company, but it's a small size of a medium-sized company. So if you put it in the portfolio, I guess it will be also medium. I believe the sales was just a little bit over 1 billion. Correct, John? Yeah.
It was over, I'm sorry, it was over what you said?
1 billion. Yeah, I think so. It's just a little bit over 1 billion.
Yeah, 1.5 billion was their sales last year.
Yeah, 1.5 billion. So just kind of a small size. So anyway, so we looked at a few companies, and I will let John to be the presenter to talk about Air Lease. And John, I'm going to make you a presenter.
Okay.
Share, click share.
Can you see?
Yeah. Oh no. Okay.
No? Okay. Yeah, that's it. It's me.
Okay. Yeah. Can you make it bigger? Yeah. Go ahead. Yeah.
That big enough? Let me make it bigger.
Okay. You can start talking. You can start. Yeah.
Okay.
Okay.
Air Lease. First of all, it's a little bit complicated, but I did a lot of trying to figure out what they do exactly, and when you try to compare them to other people, you'll find that many people have their hand in some of the business. So anyway, let me tell you why I think that Air Lease as a quality company. I think that probably one of the most important things is that the man who founded the company in 2010 had 40 years in the experience in the industry of air leasing, and that supposedly is more than just about anybody. He's supposed to be the guru. It also is a wide-ranging company with over 200 airlines across 70 countries. The strategy is to maintain a portfolio of young aircraft with widely diversified consumer base. So they tend to try to keep their airlines for a shorter time, so they're easier to sell because the life of the airline is just so long, and if they sell it within a certain time period, someone would rather buy an airplane that has 15 more years of life in it rather than 5. In terms of the financials in the company, the sales have increased annually every year since 2011. The 5-year pre-tax profit is currently 40%, and has been is currently 40% and has been increasing. Return on equity currently is 19%. Now the sales are a little harder to understand, and that's why I kind of broke them down into different years. But sales growth recently has slowed to 13% or less for the last 3 years. But the 3 years prior to that, when the company was founded, it was 44%. So sales growth has slowed down. The debt to capital is steady at 70%. That's pretty consistent with that industry. They obviously have a lot of large planes that they have to borrow money to be able to sell and lease. In 2017, the fourth quarter of the year grew at 8%, and earnings per share grew at 19%. And that had the company pretty excited because now they're going to have a tax return and money to buy more planes to increase their revenues. In 2017, the total revenues increased by 6.9% to 1.5 billion compared with increased to 1.5 billion compared to 2016. Now I have to add this note in here because I've asked, my brother has an MBA and I asked him, and I tried to research it myself, but I'm just going to read this statement and maybe somebody will understand more than I do, but it makes things seem a little strange. So this is what they have in their annual report. Adjusted net income before income taxes excludes the effect of certain non-cash items, one-time or non-recurring items, such as settlement expense and net recoveries. These are not expected to continue in the future, and certain other items. So what they're saying is that they got a write-off that is included in one of these type of things I just wrote that won't occur in the future, and the write-off is the following. The increase in Air Lease's total revenues in 2017 for the year was primarily due to 1.2 billion increase in net book value of their operating lease portfolio. So what that means is, the best I understand, is they just decided to make the value of their planes, just by manipulation of the books, worth 1.2 billion more dollars, and that made them look like they made more money that year, which I haven't found anybody to call that out and say, how can you possibly do that? So if you look at AL's net income for the year 2031, 2017, it was actually 756 million, or $6.82, compared to, let me see, 374, yeah, okay, it was 756 million, but the bottom line is if you take out that 1.2 billion increase in net book value, and they only made like $300 million. So I don't understand, because no one described it except it was in the annual report. So if anybody's got an understanding of how you can make your company look like it made 1.2 billion more dollars by increasing the net book value of their fleet, then please speak up. No? Okay. Anyway.
Does that sound like fraud? Does that sound like fraud?
No, it's not fraud, because it's stated in, I mean, there's so many people that look at this company and see different value in it, but nobody has said, hey, they got 1.2 billion in increased net book value of their operating lease portfolio. They just decided to write that in, that they're worth more, so all of a sudden it looks like they make more money, but nobody has mentioned it. So I think that maybe, I can't imagine that I'm the only one that saw it, or we're the only one that saw it. So it's possible that this is not important for the future, but it seems important to me when your earnings were a lot less in 2017 than stated, and even less than the year before. So it doesn't make sense to me. So we started evaluating the company, and then we couldn't make the numbers seem to fit, and everything seemed to be crazy. And then we went and found this. So that's, I think, where the confusion comes from. So everything else sounds pretty decent, but when you add in that little technicality or financial manipulation, it makes one very suspicious. So I'm with it. Get over talking about how the company makes money. Basically, you can read this whole thing, but I'm going to summarize it.
Sorry, John. Can I ask a question? Is it possible they're buying in the future? So they buy aircraft from manufacturers before the aircraft are actually made, and then they take delivery over a period of time, multiple years, because it takes a long time to make these things. So is it possible that that was they're taking credit for aircraft that they'll be receiving in the future?
Well, maybe they can take credit for aircraft they're going to receive in the future, but how can you take credit for sales that haven't happened?
No, that's illegal. That you can't do that. But the book value is.
Well, the thing I don't understand is, from a financial point of view, is why does increasing book value look like you had more sales?
It shouldn't.
Yeah, so. Again, this has been a mystery, and I've tried, and everybody sort of tried to figure out what it means, but we can't. But nobody seems to call it out and explain it. And I think this is one of the disadvantages of looking for a smaller company. You have less people covering the company and less people who maybe look into depth to it. So this is not really covered in depth by Morningstar, and it's not covered in depth by Value Line. So we had to, but again, we had to discover on our own. And I think that's the valuable lesson here, is that maybe you just can't, take somebody else's word for it. You have to really do your own research. So anyway, that's the one, sort of, and there lies the rub, so to speak. It may be something significant, it may not. Again, I've asked everybody that I can think of, and nobody seems to give me a really clear answer. So anyway, what the company does for a living, and we found this kind of down the road after we spent a lot of time and energy looking at the good aspects of the company. What the company basically does is it leases planes. It also sells planes, and it does this mainly in Asia, Pacific Rim, Latin America, Middle East, Europe, Africa, and North America. And those areas are less serviced by bigger markets. But they have to compete with GE lease and so forth. Anybody that can get the money to buy the plane, they compete with. They do a lot of aspects of it. And I actually, if you look on the notes, I put a diagram of the 15 things that come in the ways they do it. It's a very complex issue. But if you just remember that they lease planes, and then they sell planes, and they also manage fleets. They have various ways of making money, but the biggest way is the leasing source. Anyway, so the projected growth, now this is, again, the growth rate unfortunately is all over the place. And if you look in those notes that I have on the Google Drive, you'll see that some people see them losing money, some people see them gaining a lot, 18%. And so 10% seemed the most reasonable. That's what the computer generated sales growth was in Morningstar. So why did I pick this rate? This is based on these are the facts that make it look good for the company, based on its order book and aircraft sales plan, and us believe that Air Lease can grow its sales at 13 to 15. So with nobody really covering it very closely, I'm just trying to be very skeptical. And also due to the fact that it's a cyclic business, that they need interest rates to be low to make money, and those are going up. And the growth has slowed over the last 3 years. I decided to use a growth rate of 10%.
Hey, John, can you just show us your stock selection guide while you walk through the numbers, why you picked those estimate projections?
Yeah. Let me see how I do that now. I have to go. My Google Drive.
Oh, it's not your Google Drive live, but stock selection guy.
Oh, live. Okay. Let me see if I can get back to that. Okay. So I guess I'm going to go into. I'm going to make this small. There you go. Okay, so I can find.
I can pull it up while you're talking and then switch over.
Oh, I already have it. I have do you want to just use mine
yes,
then?
yes, switch to it.
I should be able to get it right away, actually. Just
okay, sorry, I'm already taking over.
okay.
So you can look at
Never
my
mind.
screen.
Go ahead.
And
You can use yours. That's fine.
okay, go ahead.
Okay. So anyway, we have the projections here, and as you see, I forecasted 10% sales, and I think again that's pretty much in the middle and on the pessimistic side. But as you can see, if you take this is really important to look at. If we just, and many times when I evaluate a stock, I'm superficial and I just look at this growth of 26%. That, remember, the first 3 years were 40 something, and the last few were much less, and so you have to really look from year to year and see what's going on. So if you look at the last 3 years, the growth is a lot less than it was in the first three. So that 26% is really quite a exaggeration, I think, of what's going to happen.
Do they have a one-time tax benefit last year?
No, we're going to get it. We're going to get into that, and that's even more confusing, unfortunately. They do have a one-time, and I have a statement for that. I sent a text that explained. It even makes things more complicated, but they did. But they took it off. They took it at the beginning of the year. So when we get into the numbers, you're going to see when we do the preferred procedure that it shows a negative tax rate for the year. So let me just move forward. So anyway, we decided on the earnings per share of 7.3%, and that's a little lopsided to make it less. But we got that from the preferred procedure. We did not. There's no analyst would give us really earnings growth, at least consistently. So we decided to use the preferred procedure. As you can see, the last year's tax return was 24%. Now they have a statement in the annual report that says that they're taking that tax. But what I don't understand is the taxes don't change till 2018. So how can they take the tax benefit in 2017? I'm sure they can do it. It's legal somehow, but I can't understand how. And also, I don't understand, and there's actually a Better Investing video on this that I watched, but I didn't understand it well enough to extrapolate forward and do it again by myself. But there's a way you can go through and figure out with the tax return to make this preferred procedure work. So because the preferred procedure gave us a growth rate of earnings per share rate of 7.3%, we weren't too concerned that we were over evaluating it.
I just did not understand why taxes are negative, and because we understand the benefit was about 35% to 21%, right? The company specified in their 10K. We just decided to use that 20, use the negative.
I think you have to go through and manually change these numbers using calculations, not real difficult ones, but common sense. And again, I'm going to have to, because it's going to come up all year long with new companies with lower tax rates. We got to figure out if things really look that much better, or it's just the fact that the tax rate went down, because pretty soon that's going to equalize out. So I'm going to have to, and you can look at it in the archives, where she talks about that. So I encourage everybody to try to do that so we can hopefully figure this out in the future when it happens.
Did you talk about the future growth? Where the future growth come from?
Yeah, the future growth. Let me tell you, I'm going to go back to this page and just read it to you. I'm trying to find the place out of the planes here. What drives sale growth? Supposedly over the next 5 years or so, and it's been happening more recently, there's increased passenger traffic all around the world, and obviously, which means you need more planes. The reason you might ask, why doesn't the airline just buy the plane outright? Why do they need to lease it from somebody? Is that apparently the leasing companies are better at managing the interest rates and so forth on the leases than it would be if the airlines bought them right out or did it themselves. And the reason being is that Air Lease can buy 30, 40 airplanes for 40% off, but the airlines can't. They can't take that much money and buy those airplanes because their cost, and this is the exact quote, their cost of capital is much more than the leasing company, which again, I don't totally understand, but that's the explanation. So it's cheaper for them to do it. So if there's 7% growth of passengers over the next several years, that should help. Also, they plan on, right now in 2017, they have 244 owned aircraft and 50 aircraft in the management fleet. And as of December 2017, they had commitments to buy another 368 aircraft from Boeing and Airbus for delivery up to 2023. So that would more than double. Let me see that double. Yeah, double their fleet. So, you know, we're talking about doubling the fleet in 5 years, which I guess that's the good news, is that that's where the growth comes from.
So the cost of capital, John, is just you can think of it as, you know, if two people go to a bank to borrow money, one has a better credit rating than the other, they might get a lower interest rate because they're perceived as a lower risk. And so the leasing companies typically, because they own the planes, they have assets that the bank can seize if they don't.
Well, actually, when they talk about loans, they talk about that's another thing they say. It's unsecured loans. So
yeah,
So that makes it sounds like they're not using the aircraft they have to secure the loan. So I don't get it.
That's odd. I would have thought that the aircraft would be.
I would have thought so too. But the one thing I did read, which I do understand with my non-financial background, is that you can get obviously a cheaper rate when you buy 40 planes than when you buy a couple. So that's a big savings for them. But the bottom line is, when I read these articles, it says that they lease them because it's cheaper for them to buy them than it is for the big airlines. So that's the bottom line. So they should double their amount of airlines in the next 5 years. So that's where the growth is going to come from.
Okay.
So what next? You want to go to the back side?
Yes.
Okay. Now, as I mentioned to you before, the first 3 years were a bit of an anomaly compared to the last 3 years. So that's why you had high PEs, and I don't think that's going to happen again, because you can see in 2016, I mean, you had a low PE of 6.5. That is quite low. So that's half of what it was in 2000. So I think that rapid growth got people very excited in the beginning. So we just eliminated the first 3 years, and that's why those are crossed off. Any questions on that? No. Okay. All right. So let's see. Moving down here. Basically, when you we use the high PE of 9 and the estimated earnings of 9.7. That's just comes off the graph. You get a high price of 84. For the low price, I think, can you click on that? Let me see, I think we did that manually.
Yes, we did.
Yeah, we just decided that 27, you'd have a PE of like 4 or something. So we couldn't imagine it going much lower than 27. So that's why we used that number. I mean,
it said that Jay, if you could just click on that again. It says recent market low price 22.5.
Yeah, when you do that, it doesn't work, because something happens where the low price is lower than the future low price, and then the calculations don't work because the denominator becomes less than 0.
I don't think it's this company. No, I don't think it's this company. I think it's the other company. Because here's the reason. I think that 52 weeks low is $34 here. I think we felt 34 is still too high. I think we took another 20% off. That was what happened.
Yeah.
Took 20% off, but we decided not to use. If you guys think we should use 2016 low price, that's fine.
I was just commenting.
Why don't you go ahead and click 22.5. Let's see what happens.
Okay. I was just commenting on the statement that it won't go below 27 because
there's been some growth since then too. So the bottom line is the price is important, but I think the PE is more important on a company that's still growing and had a huge turn down. So, but I mean, you can use I mean, you can
What
use
was
anything
the
you want.
price? Was before 27?
27.3, I think.
Oh.
Or 27 is fine, yeah.
So average the 5 years low price is 27.3. I just see that.
Yeah.
So we took it. I don't know. Maybe we took the average. Maybe that's what we did. We took the
We
average.
just decided that if you took that price and earnings didn't even go down, they just stayed where they were, that the PE would be so low. Now you did have a low PE of 5, but it would make the PE go even lower because earnings have come up since that low PE of 5. So
what was the low? It doesn't seem like it's 27. It gave us a whole. It was just a cutting. Can you look at the first cut? What was your low price again?
let me look right here.
I think it was 27.3.
27 was projected low price.
Was 27?
Yeah, but you see the price may have changed since then.
So it was just a buy. I don't know why suddenly that became a hold.
So why did you pick 27? I said this will be a 40% drop in the current price, resulting in a PE of 4 with the current earnings. This appears adequately defensive.
Oh, okay. Okay.
I think I still believe that.
Okay. That's weird. It was just a buy. Now I changed it, and then now I don't know what happened. Okay.
Because the price went up this week. That's why.
I know. I was already refreshed the price, and it was where you guys thought a minute ago it was buy. Now it's hold since I changed the price. But doesn't matter. Okay, just keep going.
It's close enough. It's 2.9 to 1. So and just consider this whole thing is actually a buy. Because if it was just one fraction of a point different, it'd be a buy.
Yes.
So
yes.
So basically, you've got the upside downside of 3 to 1, and again, our numbers are very pessimistic compared to many people.
Yes, very pessimistic. Yes, very conservative.
So the reason we like this is it's going to give you with a high PE get a 16% annualized return, and average PE gives you 12%. So even with really depressed numbers and pessimism, then we decided that, well, maybe this thing is just really cheap, and that's so. But then when we looked at when we finally figured out that the numbers seemed a little funny in places on the financial statement, and we read the annual report saying that they used 1.2 billion in to increase their book value, and that increase made the sales and earnings look better without a good explanation. It made us more cautious.
So by chance, did you email to their financial advisor, the investor relation, or no?
No.
No. Okay.
No, I thought you had an accountant. And I thought my brother could tell me, but last night he called me and said nothing that we didn't already know. So it's.
Yeah. I was going to ask Jane. She's the accountant. Another the attractiveness of this company. Go ahead.
What about the? Is it possible that maybe the book value is calculated based on the various leases that they have? Because like if you have a lease that ends, say, in 3 years versus one that ends in, I don't know, 10 years, the value of those is different. So maybe as the lease terms change or mature, the book value changes.
Well, they said it's a one-time event that's not going to happen again. So that's why I was a little. They said this is a one-time thing. And so I don't know why it would just happen just once, because they're going to be buying more planes and having more leases the whole time. So I don't know.
Interesting.
Yeah,
Okay.
another thing that you might notice that they pay a dividend at the 0.9% 2017, about 1%. Yeah, they pay dividend.
So I think
what happens if you increase the low price a little bit to say $30?
How about 29? What happens?
Sure.
Yeah.
Yeah. See, a little change in that number really changes the whole upside downside ratio.
Yeah. So 2 point. Yeah. Yes. Okay.
So the bottom line is that I'm being very, cautious to look at each thing we were told that didn't make sense. We ran into things we didn't understand, and I think when you don't understand is when you should be cautious.
Right.
So even though it's a buy rating, I don't want to buy something that my sort of level of competency doesn't help me understand what's actually going on. So I mean, if we got a good explanation for it at some point, it might be more reasonable to rethink it. But at this point, if it was just me buying it, I would hold off until I understood things, which might take quite a bit of time.
Well, questions for John? I forgot to introduce John. John is our guest, and he is a retired doctor. He based in Arizona. So we have two guests this month to going to presenting for us. John is presenting Annalise, and you did great, John. Oh, he has joined Better Investing back to 90s. Has been around for 25 years. Finally, now he's retired. He has more time, and he's looking for a quality club. So he found us. So thank you, John. And
That was very thorough. Thank you, John.
yeah.
Oh, you're welcome. No problem. Yeah, you know, you guys pushed me to do a better job.
Okay, good. Yeah.
I gotta
Jay,
explain
could you-
things to me. That makes me research more. So I appreciate the opportunity.
Jake, could
Yeah,
you go?
this is-
Could you? Sorry, Tom. Go ahead.
I have a question. I typed in Air Lease accounting change in Google, and there's something called IFRS 16, which, you know, I didn't have time to research it, but there was some, I guess, accounting standards that applied to air leasing or aircraft leasing, which it's a possibility that could be affecting how these people are reporting their book values and reporting and stuff. You know, I don't know about that.
But their cash flow is terrible. It wasn't even on the chart. I like to put cash flow on the first page. They had none. So that's what people tend to look at least the last when we looked before. I remember, so where's the cash flow? And you said it's not even on there.
Oh yeah, the purple.
Free cash flow. So that concerned me too, because you can't cheat free cash flow.
Well, do you think that could be because of the industry?
Don't know.
I'm wondering.
You know, I just use the Warren Buffett philosophy that you don't got to swing at every pitch, and I just think that this one maybe let go by.
Yeah, the other thing, Jay, if you could just show the scroll down at the bottom a little bit on the first page. The return on equity is the 5-year average is like 10.9%, and when you look at the amount of money that they're investing in aircraft, which is several $billions, that's a pretty low return. If you're going to allocate that much capital, then you know, and take that kind of risk, you would expect a higher return on equity.
Well, actually, 2017 is about 19%, right? So I think we're looking for 15% higher return.
But they use funny numbers in 2017, so who knows?
Oh, okay, yeah. So average, yes, you're right. Average is 10.
So unless
I'm not saying 2017. I'm saying 2017 is quite high, but the prior year.
Remember, but 2017 is where they had that accounting stuff. So maybe it changed the return on equity to make it look better too. I don't know.
Yeah. But we do, so this is quite new company, less than 10 years, and the growth in double digits. So would you guys to see the competitor, the direct competitor?
Oh yeah.
Okay. So our next presenter is Megumi. She is also our guest. She based in Davis. She is she works for SMUD, but she is a consultant, architect consultant, I think. Correct me if I'm wrong, Megumi. So we try to find Megumi. You just click share. We try to find a direct competitor in the same. Our industry category is based on Morningstar, not by Valuation. Valuation categorized air lease as a finance for some reason. So anyway, can you go to the beginning? Tell us about this Aircastle and why we picked this company as competitor. How did they make money?
Sure. So we picked Aircastle, frankly, because it had the closest match to Air Lease's graph from the 4 companies that we looked at. And the other companies were AirCap, Willis Lease Finance Corporation, and Fly Leasing. And Aircastle, like Air Lease, makes money primarily by first purchasing and selling aircraft, aircraft, but also by leasing aircraft. Is that good?
Okay. Yes. Oh yeah. I want to say,
Yeah.
Megumi is totally new to Better Investing, and she just joined Better Investing, and this is her very first SSG, and so I'm going to help her a little bit in case you have any questions. So I asked her to present the first cut. Can you? Okay, let me make myself presenter so you can look at my SSG as I walk. Do you want to take a look at your SSG? It doesn't matter.
Is it the same? It's the same, right?
Okay,
Or...
same. Okay, can you just go from the beginning? Tell us why you gave the 7% sales.
Okay, hold on. So projected growth rate, is that
Yes.
where I start?
Projected sales.
So yeah, so we're here, right? This is what
Right.
I'm covering.
Yes.
Projected
Yes.
growth rate? Okay. So we got 7% by averaging the 5 analyst estimates for 5-year growth, which was Value Line, Morningstar, Reuters, Yahoo Finance, and VICS, and just averaged those 5 numbers, came up with 7. And then.
So I want to point out something. So we want to find a really direct competitor. We looked several companies, and this company's graph looks better than any other competitors. We want to see that presenting these companies to help us to determine whether Air Lease is a strongest, is leading in the industry, So this company is a small size company. It's has been more than over 10 years, but look, our sales growth is only like 800 million, and the growth rate is still in the single digit. And given them, the 5 years growth rate is only like a 2%. I think 10 years is how much? 10 years is what? About less than 10%, I believe. So we give 7% as based on what analysts' projection, and as what she mentioned. Okay.
But the history is very much worse than that.
I know. So normally, for me, I would never project something higher than the historical value. Personally, I never do that. But in this case, because we want to present, so Air Lease, the stock selection guy was very pessimistic, but this company, our projection is very optimistic, just to see how it does. And so compared to Air Lease, I think Air Lease is much stronger in a sense. Just say using 7%. Yeah, go ahead.
Jay, why did you eliminate the first 5 years?
Oh, I think
Because
she tried to. Can you take out? Well, you can. I don't know. She was trying to get 5 years average, maybe. Oh, can you look that? No, not here. Too slow. Can you just on the graph? The x-axis, x 0, 8, 0, 9, 10, 11 on the x-axis on the graph. Yes. You removed it, yeah. So 5%. 10 years is 5%.
Yeah, 5% and 4.
Mm-hmm. So anyway, the earning per share, we gave also. Can you click a earning per share box? We gave 7%. We did not use default procedure. It was because if we use default procedure, the earnings was very low. We made assumption of we hope this company earnings can keep up the same rate as the sales. So that's why we gave 7%.
But that's hope.
That's hope. That's our assumption. That's why I said when we make this company, we want to see if this company still can compete against Air Lease. But obviously not. I think Air Lease is stronger
Yeah.
You can
I
X
think
out
I
this
did
one.
the logic.
No, they didn't have that tax write-off either, did they?
Yeah.
They didn't have minus tax rate there.
Can you click the Texas, the triangle to Texas on the right-hand side? Yeah. No, they didn't.
Well, they only paid 4.1%.
Mm.
That's
Oh, they had a lot of
really
losses,
low.
a lot of write-offs.
Mm.
And not much earnings. Not much
Yeah.
sale.
Yeah, you can X out. You can X this window.
Yep.
Yeah. Okay. So so fundamentally, we know this company is not as strong as Airlease, but this company fundamentals better than other two direct competitors. So that's why we present this company. Other two companies' graph even didn't look as good as this. Did the Airlease have something going on 2012-13 if there was a dip?
No, it just
No.
slowed down for the last 3 years.
Okay.
It didn't dip, no.
Did you do research why, Megumi?
I didn't research enough to find out why.
Okay.
Sorry.
Okay. Can you can you take a look at the second tab, valuation? Okay. So we cross out 2013 outliers. We just use the average PE of 15. For the, can somebody mute, please?
Call from 916.
Thank you. For the low PE, if we're using average 10.9, it will give us forecast to low price of 20.4, which is higher than today's. Well, this April 13 is Friday's price. It's higher than the today's price, which will give us invalid results because it will give us a -0, right? Denominator cannot be a negative. So that was why we decided, can you click on this low price box? Yeah. That was why we decided, oh, just use 2016, $15. So we use the $15 as a low price. Okay. Because our forecast low price is higher than today's price. The upside down ratio is 4.1 to 1. You can scroll down. This company also pay dividends. So I was explaining to Megumi, we cannot really just look at the annual return. This company is much higher than Airlease, right? This is with a high PE is 20%, low PE is 17.6% annualized return. But we cannot rely on that. We have to look at the overall fundamentals of sales earnings. So this company compared to Airlease is not as that strong, right? Because their growth rate was still in a single digit.
I have a question.
Yes.
I brought this up before, but maybe somebody has a good answer because I'm not sure. We're looking at a company that's not nearly as good as the other one, but yet all the PEs for this company are like 15 and so forth, whereas the other company has PEs of 8. So why are people willing to pay 15 times more earnings for this company, which is not as high quality as the other one that's higher quality? That's what I don't understand.
That's a good point.
So you can't just look at the numbers. I think you got to say common sense.
Right.
That why they've been paying that, unless you can find a reason, you just got to realize the numbers don't necessarily go along with reality. So, why is this company's earnings twice as valuable as the other company's earnings? That's my question.
Well, my guess is that high figure, the way that the earnings per share jumped up is not real earnings. That's some sort of a tax benefit or something that isn't real, and people are discounting for that.
But even a year ago, the PEs were lower. Even before
Can you
that.
show us the P? Can you go up? Auto, yeah.
No, I mean on Air Lease, the
Oh,
PEs
okay.
were a lot lower than this. Well, I guess not a lot lower. There's 2016 high low. Yeah, but still they're lower than these. So I guess my point is they're willing to pay more price earnings ratio for this company than the other one, even in 2016. Anyway, just a thought.
Any?
Is this a smaller company
Yes.
than Air Lease? So maybe there's an
1.5
expectation
billion.
that
How much does this one make?
800 million.
Yeah, so it's
Sales.
twice, it's half the size.
so maybe there's an expectation that it might grow
Okay.
at a faster clip. But I agree that the price doesn't always match reality. It's just price is more emotional and perception.
Right. See, for me, I always look at the fundamentals. I felt that the fundamental, the first half, the sales earnings, even considered a small company, did not meet my expectations. But we present this company to show whether Air Lease is in a strong position to beat out the competitor.
But when we look at the PEs, we look at the past PEs because we say to ourselves, what is someone willing to pay in the past? And they've been willing to pay more for this company, even though it's less quality. So that is a fundamental.
But another thing is that not everybody is a fundamental investors, right?
But the PE is a fundamental, right?
I don't know.
Yes.
For technical, that question for Jane, because she does technical and fundamental. Jane, do you have any input?
PE is fundamental.
Yeah. PE is fundamental, but the market is not fundamental mostly. So they will be the one to drive the price. So if they perceive this company as a smaller company, then they perceive it to have a higher growth, as Hanny mentioned. So that's why they have a higher PE.
Okay, makes sense.
But when
Also,
you look at
2013, 14
you look
looks
at
like
the graph,
really got going.
when you look at the graph in the stock selection guide, you don't really see much growth.
Yeah, but 2013, the earnings went way up, 2013 to 14.
Oh, okay.
So maybe if you look at from 13 to 17, it looks like there was quite a increase in earnings. So I don't know.
Yeah, thank you.
Okay. Any other questions before we move on? Okay, then. Thank you, John and Megumi. And so this concludes your study. I know, Megumi, I forgive you. It's your really first stock selection guide and presentation. It can be nerve-wracking. I appreciate all your time and doing this. And so, are you guys interested in joining our club?
Yeah.
Okay, great. What about you, Megumi?
If you'll have me, sure. Yeah.
So this is a test. Yeah, we will vote after the meeting, and I will let you know the outcome and send you an email. Okay. So we will cast a vote whether invest in Air Lease or Air Castle towards the end after we give presentation on the annual report. So I'm going to make Bernard as a presenter. He is going to present Ozark, supposed to be last month, but we pushed out to this month. Go ahead, Bernard.
Okay.
Click the share.
Oh, okay.
So for the time being, I asked him, because you all have supposed to review the air report. I asked him just give us a highlight of the report, because you're supposed to review, right?
Yeah. Well, so the price, well, $40 been the 52-week low, and 53 has been the 52-week high. But more important, getting down to PE, the PE has been going down. Now 13.5. Well, 13.5 is the average 5-year PE. The current PE is 14.4. But the 5-year average was 22.7. So it's gone down the PE. Let's go down a bit more and look at the real important things like revenue growth. We see a 8.7% year for the quarterly growth. And for fiscal year, we see 33.7 revenue growth, which is pretty good growth. The current assets is $21 billion, and the current liabilities 17,811, as you can see. So current ratio is 1.19, which used to be 1.17 a year ago. So it's improving the current ratio. Free cash flow in 17 was 421, 937. It's significantly higher than it was in 2016, going from 270.80 to 421. Its free cash flow jumped up quite a bit. Now we get down to the annual report more. Their historical sales growth rate for 10 years has been 10%. For 5 years, 37%. The sales forecast, we're forecasting about 12% sales growth. And so are there any questions about this? The pre-tax profit on sales, 61%. 5-year average, 55%. Trend is up, improving. Return on equity, 12.9%. 5-year average, 13.42, down for 5 years, but up for the last year. Debt to capital, 9.5%, going down. 5-year average, 19.4. And here's an important one, which is indicated by Ross Meredith as the most important measure of a bank, is return on average assets. And they say that any bank with more than 1.5% return on average assets is good. Well, this bank, 0.1% return on average assets, and that's improving over the last 5 years. I couldn't really, I went through like this 270 page 10K. I really couldn't find it. It's not isolated and easy to find, say, or forums or things like that. It just goes on and on, page after page, without not many headlines or broken paragraphs. Seems to me the annual report written by a bunch of lawyers. They used to have a lot of mergers, but this year, 2017, no. But and I heard in the reference in the conference call that one of the reasons it's hard to make accretive procurements is that their PE is low. It used to be higher, and they could make more easily to buy other banks. But in this last year, they changed their structure from a holding company to, they got rid of that branching. It's become a direct ownership. Bank of Ozark owns itself now. It's a growing bank. It used to be, like when I started doing this, it had 249 branches. I think it started with 13 branches about 10 years ago. Now it has 253 branches just over the last 6 months. It buys or acquires loans from other banks, and then it establishes also new branches. This year, they're going to change their name in June, if the shareholders approve it, part of their rebranding. Because it's becoming from a community bank, it's going more into a regional bank and with nationwide lending. The new name, Bank OZK, will help go along with their growth. And so that's my final recommendation. I think it's a solid bank that they report that they're the number one bank for the last 8 years, the number one bank in the country. I don't know about that, but they do. It's pretty steady. And now I'll go to real quick the report from our bank evaluation checklist. This Ross Meredith, he was he worked in the FDIC for 30 years, and he learned how to evaluate banks. And here we see these are things that he thinks are important. 5 to 10 year growth, 21%.
You already went through that. Can you just, yeah,
Okay.
the growth you already went through. Maybe tell us that for bank, the size of a bank is based on the assets, not based on the sales.
Yes, I have that here.
Right.
That's this bank is 21,275,647,000 in assets. It's just right over the line from being a small bank to being a medium bank. It's become a medium bank.
Mm.
And let me see what else here. There's okay, now loans and leases, non-current loans, defaults, that kind of thing, is less than 1% and steady. It's always less than 1% and improving. They don't make bad loans. Now, oh boy, I was looking for something, I can't find it.
No, it's there. Valuation checks. So Meredith Ross talk about how to determine whether the price is overpriced. You know how we normally, one way we look at the P's, right? So for banks, we also have to look at the book value.
Yes. Okay. Now this is it's interesting in that, if you look at the PEs, the PE at 14 is below the average of 18. So that's a good price.
I thought when you said it before that was above the average PE.
The average PE. In
your other study, you said that the current PE now is a little bit above the average PE. No?
I think what he had, he misspoken. He crossed out a 1 year outlier, which we will take a look at as stock selection guide in a minute. John, why don't you, let's take a note here, like a P, average P 18.5, current P 14.4. Okay. So actually, it was, he crossed out the outlier, actually.
Okay.
We can take a look at that.
Okay. Another thing I want to mention is the dividend. Their policy is annually they increase their dividend, but also annually they decrease the payout ratio. So the dividend is very secure, and paying the dividend does not stop them from making other investments and capital expenditures. That's the dividend. And I'm going to pass on to Jay.
Just a second. You actually, got interrupted about the book value. So he was saying another way to check whether bank stock is just a second. Can you move down the valuation? Can you go down a little bit? Yeah. So using price divided by book value if it's less than 1.75 in today's economy environment. So for all using, I think that's I don't know what today's price, but this price was what Bernard would initially, maybe last month, studied. It came out as 1.95. If you see it's greater than 1.75, you can stop right here. You already know this stock is overpriced. If it is less than 1.75, he suggests that continue to take a look at tangible book value, which use the stock price divided by tangible book value. So Bernard went up, calculate anyway, so calculated is a 2.46. So it is overvalued. So we cannot, so bank is a little bit different how you evaluate whether it's, is buy, the price, whether it's a buy. So this tells us that Ozark is overvalued, overpriced right now. But obviously he's using 52.70. I don't know what's today's price for Ozark.
It's 46.31.
Okay. 46 what? Point?
1.31.
Okay. divided by 26.9.
So
Yeah,
in terms of
1.73. Okay.
in terms of historical book value, I mean, in terms of historical PE, it might be considered a buy, but if in terms of book value, it's overpriced.
Yeah.
Yeah.
I
And I'm
mean,
gonna,
divided by 21.45. Yeah, it is overvalued. The tangible, yeah, I just calculated using today's price. It is the tangible value is also it's a 2.15, so it's greater than 1.75. That means it's overpriced. Okay,
Did you
now
get
let's
the-
take a look at the
Did
SSG,
this
and
chart,
I'm
sorry, did this chart come from the Better Investing lectures, that 1 and 2 lecture on banking stocks?
yes, that's
Okay,
correct.
thank you.
I made a notes under education topic members under bank analysis. I created a note based on that 2 presentations. I highlighted what's important, what he said. So just for your future reference. Anyway, so go ahead, Bernard. You can go ahead, tell us your SSG. So we ask for annual report must conduct a brand new SSG. That's
yes,
weird.
and I
Why this is not removing? Hold on just a second. That's weird. Bug, go ahead. Don't wait for me. Just go ahead.
oh, okay, wait a minute now. Okay, here we go.
Mm.
I'm trying to look for the stock selection guide.
It's on my
Oh,
screen.
here.
Oh,
Oh,
okay.
here it is, right here, I think. Yeah, I think it's right here, Jay. And I'll
I'm
let you
showing
walk.
it on my screen.
You're good. Huh?
You can
I
just
thought
look at my screen.
Oh, okay. Well, all right. I'll try that. Is this it? I'll let you do. I thought you were going to walk through.
I am. Oh, you wanted me to walk
Okay.
through? Oh, I thought you wanted me to present.
Yeah, you were going to present the stock selection guide.
I am presenting.
Okay, good.
Can you see it?
Yes.
Yeah. Okay.
I think he thinks that you are going to speak to it, Jay.
Oh, I'm going to speak to no. I was helping you to because Bernard used a core SSG.
Oh,
So I was telling him that I can help him to use the SSG plus. So okay, sure. Actually, Bernard and I we did together. For the sales, he used this is the prior last SSG. So the sales is remain unchanged. We use 12%. For the earning per share, we decided to use preferred procedure. So we justified the taxes to use 21%. We modified shares outstanding. Oh, sorry, shares outstanding. We modified the share outstanding to match 2017. So these are the 2 numbers we justified. For the last, I don't know why there's a 0.1% difference. I think maybe we calculated divide by 5 yeah. But anyway, so this is what we did. We used the default procedure to come up with the earnings. So for the high PE, I think we much lowered. We did not take any outliers, but we lowered the average high. We use 18% because I was explaining to Bernard. That's what I learned is that if the company can double our money next 5 years, that's great. So we don't want to over project. I would rather be underestimate. So the today price is 46. So if we double it, it will be about 92. However, so this is the question that John was just asking. So the 14.4 is if we take the 5-year average is a 14.4. I think he took 2014 as a outlier for the low PE. So he used a 13 instead. But we did not, personally, I think I was explaining, I said ideally I don't like a projected low price is a higher than 52 weeks low. that was why that we decided to knock down a little bit. We knocked down 10% more, just about, to using 37. So it is still in a buy, and this company pays dividends, and the return with high PE is about 19%, and with low PE is about 15 points, about under 16%. But I think we have bought this company twice, I believe.
Which company is this?
Ozark, Bank of Ozark.
I thought we just said that it's overpriced by book value.
Right, it did. Yeah. So looking the SSG is a buy, but looking the evaluation that Ross Meredith presented, which is overpriced.
Yeah.
But
they have a
Bernard's final recommendation is still a buy. So
is there an SSG specifically? I thought he said there was an SSG specifically made for banks.
yes, it is. This is. See, look
this
here.
Is it. Okay.
Historical total assets and return on average assets. Oops, sorry. The last line, we want to make this number, if the company is greater than 1.5, considered excellent bank. So for total assets, I think he probably also have a guideline. Well, the idea is to kind of like a sales, you want to look these numbers as a grow steady and up and grow steady, so which it is. Another number is looking at the provision expense ratio. This company is under about 0.1%. We want to be a net less than 1%, which this company it is. So anyway, yeah.
If you look at the return on average assets, though, it's never been in the buy range for the last 9 years. Right?
Say that again.
Well, you said that the return on assets should be less than for be in the buy range.
Greater than 1.5. Greater than 1.5.
Oh, greater than 1.5 to be in the buy range.
No. This is the fundamental. You look the bank. This is one way to examine whether the bank is a quality bank.
Yeah, it's the price to
more than
book.
1.5. Total return on
price to
total
book.
assets is considered to be great.
Greater than 1.5, which
Yeah,
this
okay.
company is about 2% 5-year average.
This company consistently outperforms that bank benchmark.
Yeah, I think John was referring to price to book value.
Price. Yeah.
Oh, price to book value. Okay.
Yeah.
I see. Sorry, I did not.
No, I was looking at the wrong thing, but that's what I meant to say. Thank you.
Oh, okay. Okay.
So is there a line for price to book value in this SSG?
This is this is the black line is the the black line is the book value.
But we don't have price to book value anyplace.
No, we don't. Which but not calculated, right? It was greater than 1.75 in
Right,
this
but there's no place on the graph that shows price. Okay.
No, it didn't. It doesn't. Maybe we can tell Better Investing they can provide that. No, it does not.
I want to mention that tomorrow night there's a webinar, a Better Investing webinar on the Bank of Ozarks.
Oh, great.
Yes. Under not Better Investing, under Rocky Mountain chapter.
Oh.
Okay.
Can we go to that then or not?
What?
Can we? It's going to be a webinar. I think we could log into it, right?
Yeah, it is a webinar, but I'm saying not under home office Better Investing, it's under Rocky Mountain chapter.
Where do you find that on Better Investing?
I will forward to you. I can forward to you the email.
Thank you.
Okay.
Yeah,
so this is an Ozark, and I'm make Hanny a presenter to present HCLP. Sorry guys, we're probably running late. We need to chop. We have 2 more companies. Okay, Hanny, I'll make you a presenter. HCLP. Maybe you can just summarize, give us a highlight of how HCLP do. Hanny, you are muted.
Hi, can you hear me now?
Yes.
Yeah.
Okay, so this is High Crush Partners Limited Partnership. or High Crush Limited Partnership. They mine sand that's used in fracking in the different different frac zones
Fracking.
or what have you.
Okay.
Anyways, fracking, yes. So that their performance is been improving significantly. If you look at the sales growth rate, the quarterly growth is 195% roughly. The trailing 12 months is 221%. The sales forecast from our last SSG was 35%, and I redid the SSG. Now I just have to warn you, I didn't have time to update the numbers for today, so these numbers that you're looking at are probably about 2 weeks old. So I apologize for that. But the sales forecast based on current SSG is about 7%, and earnings about, again, pretty significant. You can see 4,600% earnings trailing 12 months. That's because they had negative earnings before, so that's why that number is so big. So I won't go through all of this, but basically I'll just the company has just completed a large project in the Permian region. They have a mine in the Permian, which allows them to service their clients fairly quickly, and it also reduces their transportation costs because it's close to the end users. And the Permian Basin is one of the largest production basins in the United States, so it's there's a lot of potential going forward. I think they've been hit a little bit with the turbulence or turmoil in the markets, and you could see this chart is last 1 year chart. So it's been up and down quite a bit, but if I change this to 2 years, you'll see the stock was up to at $22.61 at the peak earlier on. So there's potential that it'll go back up to that, given that they have completed this mine in the Permian and will start to realize earnings as a result of that. So my recommendation on High Crush is to continue to hold and just watch it.
Okay. Can you show
Does the
us
stock price track the price of oil?
Yes, a little bit, because obviously it's the drilling. The drillers are their customers. So if the price of oil is higher, then yeah, there'll be more wells drilled.
They frack gas too?
Yeah.
Yes, both.
Hanny, I have a question about the analyst estimates.
Yes.
Can you go back to your sheet?
Okay.
Yeah, so there's like, they look like they're like the next year, it ranges from like negative 19% to positive 31.6%. Why the big swing?
I don't know. I think everybody's got different, expectations of where these guys will be, and there's a lot of uncertainty about price of oil. You have, a lot of geopolitical perturbations with, Middle East, Syria. All of these things will impact the price of oil, and it's kind of anybody's guess as to where we'll end up. So,
And is there a value line on them?
Sorry?
Is there a value? Does the value line?
No.
No, there's
No, I was able to find a Morningstar, but not value line.
Okay.
Was the Morningstar computer generated, or was there a big discussion?
Sorry, was it?
Was it, in other words, Morningstar, the smaller companies, the ones that aren't that followed, they'll do a computer generated analysis, and it won't actually be a discussion with an analyst actually looking over things?
I can't remember, to be honest, if it was if there was a report or if it was
What's the symbol?
HCLP.
HCLP.
Oh, HCLP. I'll take a look. All right, thanks.
Okay.
So you
Yes.
There should be a value line growth projection, right? Because it's a value line company.
For some reason, I didn't include it. I don't know if I couldn't find it, or I'm trying to remember because I did this a few weeks back. I'll check, Jane, and I can let you know.
okay. Did you see? Do you have a SSG? Did you say as a hold? Did you make any changes on the stock selection guide projections?
No,
Or the
I think
numbers are-
I wouldn't be buying more at this point. I would just watch and see what happens. I think that you know, we bought it at $8 and it's around 11 something right now. So you know, there's a, I think with oil prices going up, it's possible that, and with the more than oil prices, the fact that they completed their mine in the Permian, I think you'll start to see a little better performance as a result of that.
Morningstar does have a big write-up on it, by the way.
Okay.
A huge discussion. So,
So,
anyway.
Right.
Hanny, why wouldn't you put it in a buy?
Actually, his
If
SSG is
you-
sale.
This says she
If
said
you-
sell?
Yes.
Oh,
But
there
I
you
want
go.
to mention for the members that if you look you add this ticker to SSG. This is a cyclical stock, and we use this company as for education purposes.
For
If
education.
you're looking, if you're looking the graphs, they are not up straight and parallel.
Yes.
That was our idea why we did that initially.
And if I recall correctly, it was Joanne who said that she
Jane.
wanted to. It was Joanne.
Oh.
Jane brought the company up, but it was Joanne that said, you know, we should follow a cyclical company. So we're following it.
Yeah.
Okay. Yes. Oh, was it? Okay. Yeah.
Yeah.
So based on your SSG is a sale, I'm looking at, but
Well, my rationale for that is, you know, again, if you're in this for the short term because it's cyclical and it will eventually go down, and oil prices are high right now. The stock went up to about $12, $13 recently, and then it started to come down. So this would, if you're playing, you know, a cyclical company, you would take the profits and run, and then look for something else.
yeah. Okay.
But it's not a decision based on SSG. It's more, I would say, based on technical analysis, looking at the
Right.
stock price.
I also want to point out one more thing. This company's LLP. When we do our stock studies, we look at the energy sectors. There are a lot of LLP. So John was saying that there are some sort of tax complication if it's LLP, because you have to file K1. It happened to me too. But unfortunately, I invested in my Roth, so it really doesn't have any tax implication. But if you invest in LLP, like this company, in your regular brokerage account, there are some sort of, you have to file tax, even if, because
To give
it's
you an idea, my taxes just went up, and my accountant told me that after you sell the LLP, that all of a sudden, all those tax advantages you had for the last few years, you got to pay them off, then you get a write-off later. So it's really complicated. Anyway.
Yeah, so that was one of the reasons that we were looking when we were researching for the sectors that we don't have energy, and we looked, when we saw LLP, we just decided not to. So that was another reason. Okay, all right. Any questions for Henny?
I have just one other slide I'd like to show real quick.
Okay.
Which these are the two companies that we were studying today, Aircastle and Air Lease.
Mm-hmm.
And I'm just comparing these to the Dow Jones US Specialty Finance ETF, which is the red line. So if you go like this, you can see how they're performing relative to that. If you want to make it, if you want to make the ETF as the baseline and compare it, they're both lower. So just
non-performers. Yeah.
Well, relative to this ETF, they're not performing very well. So
So,
in
Haney,
this year.
what's the most important oil price? Is it Brent or WTI or what?
Good question. I don't know.
What?
I wouldn't think it would make any difference. I mean, one's higher than the other, but don't they just sort of track each other? I mean, as if one rises, the other one rises. If one
They
falls,
seem to be
the other one
parallel.
falls.
Yeah. Okay.
Okay. Okay. Any other questions? Mina, you're quiet. Do you have any questions? Feel free to ask. Okay. So 5, the last one. Joanne?
Yes.
Thank you, Henny.
Yeah, very good, Haney. Thank you.
You're welcome.
Sorry. Okay, this is an annual report for 5. Oops, sorry. I'm going to be quick about it. It's a consumer cyclical, specialty retail. Matt's not here. He's the only one I think that's been to the actual store. It's a store for teenagers. We bought the stock like a year and a half ago at 46. It's now at closing price today was 76.39. They had a really great last quarter. The holiday season is a big quarter for them. They're doing well for us. They're forecasting their revenue growth. I think it's 20% through 2020. So the last for the last year was 27.7%. They're performing well. One of the things that I saw that and one of the things I did change was our earnings forecast on the SSG. The last one was 16.9. I did adjust it based on the change in the tax rate. So it came up to 21.6 for preferred procedure, but I changed it to 20 so that earnings follow sales. So return on equity is down.
Even down, still is at 26%.
Yeah.
Yeah.
Okay, and so their eventual goal is 2,500 stores, and they're looking at 20% growth through 2020. So far, and then this they just announced a stock share repurchase for 100. I guess that's 100 million. And then there's a planned transition of the co-founder who's going to go to leave, but he's still going to be on the board of directors.
Question?
Yes.
Same store sales, what are they doing?
Same source sales. So
What is that?
Same
Just
source.
one of the percentages.
I was gonna ask the same question.
I know you
Sorry,
asked me
I did
that
not
last
understand.
time.
What?
I think I need
What's
to put that as a thing in this my reports.
Sorry, I did not understand the question.
Same
Can you
source.
repeat it?
So same store sales are just
Oh,
the
same
sales
store.
that,
Okay, okay, got it.
yeah.
Okay.
So if the same store sales are going up, that means they're getting more traffic through their existing stores. They're not
Right.
growing. They're
Yeah.
growing organically as opposed to opening new stores in new jurisdictions.
Right.
Okay,
Do you
Which is
have
a-
that number?
I'm gonna
For
look
retail,
that,
that's a big.
I'm gonna look that up and then email everybody.
Okay.
Can I not living in the United States? What is the Jobs Act legislation? It says as a result of tax cuts and Job Act legislation.
Oh yeah, that's the text. Yeah,
Don't even think about it.
Okay.
that was the text that we were all talking about tonight.
It's the tax scam. It's the
That's
tax.
the name of the tax bill, I think.
Oh, it's
Text,
called
yeah.
the Jobs Act. Okay. Because in Canada we've had legislation that increased the minimum wage, which has
Paul Trump.
caused had a lot of impact on retailers.
Okay. All right. That's all, Joanne. More?
Yeah. Oh, and so I have it as a hold because the price potential is below 100% and the upside down ratio is 2 to 1. Let's see if I have. Oh, Sorry.
You are tabbing, right?
I can't find, yeah, that thing gets in the way. Oops.
Oh.
I keep clicking on that dashboard.
Oh.
I can't get it out of the way. Okay,
Oh.
so I blocked out the 2008, 9, 10, 11, 12, because if I undo that, then the numbers look crazy. Let's see.
The comparable store sales increased 5.9%.
Okay, thank you.
Welcome.
So, like, this would show
Really good.
Go
So
ahead.
does that mean the 5% is a good number? At least the increase,
Yes,
right?
very good. Very good.
That's really good. Yeah.
So those
I don't think it's teenagers, it's teens, I think. Teens.
Tweens.
Oh, tweens?
Tweens
No,
and
teens.
teens. Tweens and teens.
Yeah, because they have a lot of like electronic devices and also comic book related or Disney related themes, and kind of they call it the trend. They base their products on what's current now, so they try to be ahead of what the trends are.
I think you need to unblock 2013, so you will give you last 5 years. Okay.
Okay.
How many stores do you say they want to end up with?
2,500.
How many do they have now? Do you know?
Yes, they have
625.
650 now in 32 states.
Okay.
Wow, 32 states. When we initially studied it, they don't have any West Coast.
No, they opened in California.
I think they also have an online presence, so I don't know how much they're selling online, but that would be interesting to know.
Probably not that much, because I'm thinking their products are all $5 and below. So to make that economically, I don't know.
They might want to use drones.
Right, use drones. Yeah.
Okay.
Just use UPS, it's free.
So that's 5. I say we'll keep holding it, but don't buy any more.
Except the John, he can buy.
I should have bought some to begin with.
You didn't buy any?
I own some, so.
Oh, shoot. I don't know how to do. Jay, you'll have to show me how to do this where I don't.
Oh, okay. So there's orange button, you can control panel, you can
Get it out of the way?
Yeah, right, get out of the way. The orange.
Okay.
Okay.
So
Okay.
briefly, this is their PE ratio. So what I've learned is that when you look at the PE ratio to see if they've got expansion for growth, is to look at the current PE ratio and then compare it to the average. And right now it's a lot higher. So to me, that signals
But this company's PE is high from the beginning. Like, that's crazy. Like 90, around a 40. That's just crazy. Yeah. Okay.
Okay. All right. I think
What's the annual return give us? Even as a hold, can you going down with that? What's the, oh, okay, 12%. Yeah. Did you say we already doubled our money?
No,
doubled our investments?
No, but we purchased it at 48. And now it's at like 78.
Oh, okay.
No, 46. We purchased it at 46 and it's at 76.
Okay. We're doing good. Okay, Ben. So now it's time for us to make any motions to buy any stocks that we have presented tonight. We presented Air Lease, Air Castle, and 5 Ozark HCLP. Okay, I have to ask you this, John. What's your final recommendation for Air Lease?
More investigation, hold.
Okay.
Until I know what those numbers mean, I wouldn't buy.
Okay.
If I could rationalize them, I would buy. Yeah.
Actually, Joanne and Tom, I don't know if you guys remember, Air Lease presented it when we first started the club, but I couldn't find the documentation on First Cut. Why we did not buy this? I couldn't find documentation on First Cut and why. Did you guys remember, Tom, Joanne?
Why we didn't buy it?
Why we didn't buy it? I think
I
Tom vetoed back
I
then.
I don't remember. I used to hold it. I sold it. It was disappointing. The price has gone up quite a bit from when I owned it. I wish I'd just stuck with it.
Yeah.
But I don't know. Right now the finances just look a little bizarre. But I think it's a decent company if you want to be in that area. But it would be helpful to if we could understand the finances and the accounting.
Mm.
I think they're going to have their next, I think in May, they're going to show their earnings for the first quarter. So it might be interesting to see what they do then.
Okay. So
Maybe the treasurer could recommend what we buy, because he just went over our whole portfolio. Maybe he could see what we really need. But go ahead. That's if we
right
don't
now,
if
okay.
we don't buy one of these, maybe the treasurer, because we have a lot of money.
Bitcoin.
Are you guys interested to see the company's portfolio on the PERT? What's in a buy?
Okay.
Okay, I can show you if you make me a presenter. Of course, I could make myself present. I'm busy to updating data. Okay, I can show you. Oh, am I the presenter? Okay. So this is the PERT. Let's see. How do I go all the way? Based on the PERT, Bank of Ozark, Biogen, Facebook, FleetCor, MIDD, and Disney are in buy.
It says 5 below is a buy also.
Oh, 5 below is a buy?
No.
Says
Hold.
Oh, okay, sorry. Facebook.
Facebook, I cannot wait to. I wish Matt's here because he's the one that.
Doesn't
Is
like.
that Facebook a quarter one next month? Quarter, yeah.
Yes,
I want
yes.
to. Yes, I want to hear Jean's report on Facebook.
Yep.
Yeah. So here we are. Do we have any motions to buy any?
I would buy Bank of Ozark.
Huh.
You're a one-trick pony.
Yeah.
I know.
Well,
You said,
But
Bernard, you said that the price was high though.
yeah,
Yeah,
okay.
you already said that the price was overpriced. Right now we have 8%. So do we have any other motions?
What about Biogen?
I'm not real positive on Biogen at this point. I heard, I guess they've got earnings coming out. Their valuation is not very high, but I don't think they don't have any exciting news at this point. So I think
I
they're
think the only ones that. Sorry, Tom. The only ones we could make a decision on today would be the ones presented, because we haven't done any SSGs for Biogen or some of these other ones, right? So.
Yeah, we did a Biogen for last month at the annual report. I think Tom recommended it was hold.
And I think I have a quarterly report coming up next month.
Next month, yes, then we can decide. I agree. We can do Air Lease, Bank of Ozark, 5, and HCLP.
And none of them were in a buy, a recommended buy.
Yeah, that's right.
Air Lease is, but it just has funny numbers.
So yeah, so what do you guys think about Air Lease?
Well, it's funny money, so we could buy some Air Lease.
I know, but we cannot think that way, right? We have to be a disciplined investor, right? So yeah, we cannot.
I agree. If we don't understand it, we shouldn't buy it. I think until I agree with John. We should wait and see.
Okay, I move that we don't buy stock this month.
Okay.
Yeah.
I second that motion.
Okay, second. So very quick, I forgot to mention. Oh, thank you, guys. So we will not buy. for next stock presentation, so Mina is our guest, but I think he's also a pharmacist here in Canada. Somehow tonight he's not here, so I'm going to cross him out.
No, Mina is a lawyer. He's a
Oh,
lawyer.
Mina. No, it's a guest Mina. You guys have the same first name.
Oh,
spelling
gotcha.
differently. Oh, not you. Now you're Mina. Well, Mina, you're very quiet. Do you have any questions?
No, just
He might sue you for calling him a pharmacist.
No. He's not. He's a lawyer. He's a right recent graduate lawyer. Work for an insurance company. So yeah, the other Mina has business a pharmacy. I'm so happy we'll have a pharmacist and we're going to have a doctor in the house. So maybe help us to help us determine medical pharmaceutical companies. So Tom and Jane. Tom actually supposed to be a Roy and Jane, but Roy has conflicts. So Tom, are you okay to do stock study next month?
Yes.
Okay. I know you will have a quarter report too. So we have a Biogen, IPGP, Disney, Skyworks, Facebook, Ozark, FleetCor, MIDD, Realty Income, Public Storage, HCLP have a quarter report due. And so that I'm going to, if you have anything that I'm going to, so shall I do the officers election right now, or shall I do the open mic to the guests first?
One question before you do that is, because you had Mina on the stock presentation, so is he working with Tom and Jane, or because you took the name out?
That's the different Mina,
Oh,
not
the other
Mina.
Okay.
The guest Mina, but he did not. He called me. I was hoping he will be on it today, but he's not. So I took his name out. He's spelled as MEINA. Our Mina is spelled as MINA.
That's it.
Yeah. I forgot the last name, but yeah. Anyway, so should we do office election first, or should we do the open mic first?
Now do the
let's do the elections, and that way not everybody needs to stay on.
Yeah.
Okay. All right. Go ahead. So go ahead, Tom. You are the nominating committee, and why don't you walk us through the process?
Well, I've never done this before, so I guess bear with me. I guess can you show the ballot?
Mm-hmm.
So we
What's
have
your email?
we have a one candidate for each office, I guess, in socialist tradition, and we can either vote yes, no, or abstain. I guess it's if somebody's really interested in running, maybe we could you could throw your name in the hat, but we put out a please, or not a please, but we put out, these are the people who volunteered. So, I think they're all qualified. We know them all. They're all qualified candidates. So I guess at this point we can vote unless anybody has any questions. So if you're a member of the club and you received the email, then please vote. And pardon me?
Do we need to make a motion?
I move we vote.
Okay.
Second.
Okay. Go ahead, cast your vote.
But don't show us, Jay. We can see.
Okay, I want to show you. So who should I? Okay, I'm going to. So who should I?
Oh, you can do it on mine. I voted on another machine.
Okay, got it. Okay, I will make you presenter. Actually, supposed to be, because you're going to tally the vote. Are you going to tally the vote, or suppose Tom? But I don't know if Tom can find it.
Well,
Tom, do you have Google Drive open?
No.
Okay. Then I'm going to let our secretary to tally the vote.
How do I not show my screen?
What do you mean? There you go. Here's your screen.
No, that's not what I want to do. Let's see. Wait.
I'm having trouble.
Okay, I see.
I'm having trouble with the form here.
What's
the trouble?
Well, I put in my email address and then I clicked on it and then it brought me to another screen and this. Oh, wait a minute. Okay, so now I can vote. thought I needed to put in my email again. Let's see.
Joanne voted, Henny voted, Jean voted, Jay voted, Bernard voted. Thank you, Bernard. Yay! Tom.
Okay.
So we miss Mina.
No, I've submitted my ballot.
You did? Okay, let me refresh.
Let me try again here, actually.
Wait, Mina, you need to vote the officer, not the stock.
Oh, sorry, no, yes. Oh, the officer here. Oh, I just
Yeah.
should be it now.
Yeah.
Okay,
Yes.
so
So 100%. 100% president. Oh no, treasurer. Henny, is that you?
What's
Never
that?
mind.
Sorry.
What?
Sorry.
Okay. So, so I'm not. So supposedly, Tom is going to make an announcement. Apparently, it's not on your Google Drive is not on. So I'm going to make the announcement that our candidates all got the majority vote. So our president will be Joanne, and vice president Jane. Treasurer will be Henny, and I will be the secretary starting next month. All right, I'm retired. Yay!
Oh, yay. Well, congratulations to all the new officers.
Very good. Very good.
Thank you.
Okay.
Thank you.
So now I'm going to go through the open mic to our guests. So first person is BC. I unmuted you, BC. I have seen your name before. I've always registered BC, but I have not talked to you.
So now are we done with the business part of the meeting?
Yes, we did.
Yeah. How about, do we have new members to vote in?
No, that will be after. We will go after, and we decided
So then
for
we're
the
not
member.
done with the business part of the meeting.
Actually, for the member, we decided not waiving the business portions, not waiving the meeting. It's after the meeting. After meeting adjourned, we're going to vote the member.
Okay.
Okay, BC raised the hand. Okay. Oh, hi BC. You are unmuted. He raised the hand. What is? If your mic is not working, you can type under the chat box. Let us know what you think or if you have any questions. He raised the hand, but I don't know. I cannot. I'm gonna give you a minute. You can figure out. You can type it in the chat box just in case if your mic doesn't work. Next person is Ela. Ela. Hi, Ela. Ela. You are unmuted. You can please let us know if you have any questions or comments. Again, if your mic is not working, you can type up in the chat box on the panel. I just keep going. Jacqueline. Oh, Jacqueline, you are self-muted. Okay, Jacqueline self-muted, and I'm going to next Roro. Roro. Hi, Roro.
Hi.
Hi.
Thank you, guys.
Yeah.
No, that was great today. Thank you.
Okay, thank you for attending. You're always welcome.
Thanks.
Okay, Jacqueline. Oops. Go
There,
ahead.
am I unmuted now?
Yes, we can hear you.
I appreciate the meeting, especially the treasurer's report. That's the first time I've heard such a detailed treasurer's report. And that was very beneficial.
Okay, great. Oh, thank you. Yes, I'm so happy that Henny is going to be our treasurer, and so I'm so looking forward to his term. Yes, thank you, Jacqueline. Okay, Neil. Okay, he's not tentative. I'm going for Ruby. Neil, you are self-muted. Again, if you can type your comments under the chat box. And the next person is Sally. Sally also self-muted. Sally Cooley. Okay, they have questions. Eli says, sorry about delay. I don't have mic. Enjoy the research reports. By the way, can you suggest a mic brand? Okay, guys, Eli's asking for a mic brand. I think a Logitech works. Right? Do you guys agree? Logitech?
Yeah. Logitech.
Okay. Logitech. Logitech, Eli. So Neil also typed comments said that he have really loud kids. Okay, all right. Let's see what else. That's all. We got 2 comments. Well, thank you so much, guests and members. Oh, I do want to point out, guys, for the members, our membership is due for next month. We will not have club dues. As I mentioned, we got waived for the $48 because we have 3 new members. However, I believe me, Joanne, Andrew, our memberships are due. So I think that's it. I think Henny is going to pay on his own, and Matt and Tom, you guys' membership is due in November, so I'll let you take care of your own membership, okay? Would that work?
Yes.
Okay.
Works for me.
Okay. So
I can send it to you if that's easier. It doesn't matter to me.
Yeah, I will show you guys the new form, who's owing what, because I need to send it to be. Actually, it's supposed to be treasurer. It's supposed to be Roy is supposed to do that. But I can, since you are going to be the treasurer, I can either let you take care of a Henny or whatever. So Jane and Bernard are lifetime members, so they don't owe any forever. So that's all. Mina, I still need your member ID so I can add in to. That's all. So okay, I'm still looking forward to Joanne's leadership as president. I failed working on time management. We went past the half hour again, and so hopefully we do better under Joanne's leadership, facilitating better or have better time management.
Okay.
Okay. All right. Meeting adjourned. I forgot to say that. Oh wait. Also, members, you guys need to stay and vote on the new new prospective members.
Yeah.
So I'm going to dismiss the guests, including John, and I will let you know, John, the outcome.
Thank you.
Thank you.
I think it'd be good if you would let those guests unmute themselves and talk. But
I did. They didn't talk. I unmute them. They are
okay.
self-muted. They self-muted.
Oh, I thought they could, but they could click on a button and unmute themselves, couldn't they?
Yes, they could, but they didn't.
Oh, okay.
So
Maybe-
Ela said she doesn't have a mic, and she so she apparently she's getting on one. Laurel talked. Neil said that he has loud kids. Ruby did not talk. Sally didn't say anything. I did. Sally is self-muted.
Jay, you need to look at that Laura Scott comments about the how we're listed
Website.
on the BI
Website?
Yeah. I don't know.
Yes.
Okay.
Yeah, I will.
Okay.
Okay.
Because we don't have a website outside the BI.